What's up, boys? In this video, we're going to talk about CVD divergences. Spotting a CVD divergence can be such a cheat code for entries. So in this video, I'm going to show you guys what they are, how you can use them, and I'm going to show you two examples, one from GC and one from ES today. Before I show you that, make sure to subscribe to this channel. I post tons of valuable content for free, specifically for futures trading using order flow. Also, make sure to go check out my TikTok and my Instagram where I post strictly order flow trading related content. So with all that being said, let's hop right into what a CVD divergence is and how we can use it. All right, so first off, if you don't know what the CVD is, that is the cumulative volume delta. It is basically the delta of aggression coming into the market, and it moves as time moves forward. So on your order flow software, it's either going to be a line like this, which is how it is on Bookmap, or it's going to be set up like a candlestick chart. I prefer personally the line on Bookmap, so I'm just going to mainly give you guys examples using Bookmap in this video. The same logic applies to the candlestick charts as well. All right, so what is a CVD divergence? It is simply when the CVD is doing something that price is not. For all these examples, we're going to use the CVD on the bottom of the screen and we'll have price at the top. But instead of just looking for these divergences, we want to understand what it actually is and what it's telling us. So like I said earlier, the CVD basically is the delta of aggression coming into the market. So if the CVD is moving up, that just means there is more aggressive buying than selling as time is moving forward. So let's say the CVD is moving up, but the price is moving down, or the price is moving sideways. What this is telling you is there's aggressive buying coming into the market, but despite that, price is either moving down or it's not moving up. So what's happening here is aggressive buying is getting absorbed by passive selling. The reason we're able to deduce that from what is happening is every single aggressive order is matching with a passive order. So for price to move up, we need aggressive orders taking liquidity from the passive sellers. If there's not enough aggression to move price through the passive sellers, price will not move up. That's just how it works. So basically what I'm saying to you is that a CVD divergence is another way of spotting absorption. So as an order flow trader, you're constantly looking to see, are buyers or sellers getting rewarded in their effort to move price? If there's aggressive participation that's not getting rewarded, most likely if they get put underwater, they're going to exit their positions, which is just going to put more fuel on the fire for a reversal. So for a bullish CVD divergence, what would we want to see? We would want to see sellers getting trapped or sellers getting absorbed. So in other words, we might want to see the CVD moving down, and we might want to see price either moving sideways, or in some cases, it might even be moving up. So a bullish CVD divergence would look like sellers getting absorbed. Sellers are putting in effort to move price down and it is not moving down. So what's going to happen? To exit their positions, they're going to have to buy it back, in turn creating a bullish reversal or a bullish continuation. In a bearish case, it's obviously going to be the exact opposite. There might be a lot of buying coming into the market, but despite all that buying, price is either moving sideways or potentially even moving down. If there's a ton of aggressive buying coming into the market and they're not getting rewarded, and price starts moving below where they entered at, a likely situation is going to be they are going to exit their positions, which they have to sell, and in turn that's going to fuel a reversal to the downside potentially. So now you know what a CVD divergence is, you know what to look for. Now how can you use it? So before I show you some real examples, I'm going to show you how I would use them personally for the highest probability chances of taking a winning trade, and I'm also going to show you how you can avoid entering early and avoid some losses. So we're going to start off with a bullish case scenario. So let's just say that this vertical line right here is the session open. If right off the session open, we get a bullish move, we're moving upwards, there's aggressive buying coming in, and then we get a pullback or consolidation where we're moving sideways, and the CVD looks like this. We'll have some buying, then immediately after this buying, you see the CVD moving down very sharply. This is obviously a bullish CVD divergence. There's a ton of selling that is not getting rewarded, a ton of selling that is getting bought up by passive participants, specifically passive buyers in this case. So we see the divergence, but when do we enter? So we see the divergence, but when do we actually take a trade? That part can be subjective to your own trading. You can make these decisions for yourself. I'm going to show you personally the highest probability way you can actually do this in order to avoid some losses if you're premature on the entry. So it's really very simple. Instead of entering immediately when you see that there's a divergence in the price and the CVD, what you're going to do is wait for aggressive buying, in this case, to come in. So on the CVD, obviously you're going to see that aggressive buying coming in right there. You're also going to see price moving up, hopefully putting all of this selling that came in underwater. Then this is going to be the point where you can enter the trade right here, put your stop loss either below the low of the consolidation or where there was the most delta or the most absorption. And then you can try to ride a continuation setup to the upside. So I will personally wait for buying to come in. I will not enter until the aggressive buying comes in. Sometimes I will enter if price moves up and puts all of that selling underwater. So if there's a ton of selling at these prices and then we start moving above where all that selling was, I'm willing to take that long and have my stop loss at the same place, usually right above the low. So like if this is the wick, my stop loss will never be at the low. It'll always be just above it. And that's a personal preference to avoid some slippage. That's how I do it. The main point I'm trying to get at is that if you wait for the opposing aggression from the absorption, you have a higher chance of it winning. Sometimes you can get an instance where a ton of selling comes in, you see the divergence, and maybe that aggressive buying just never comes in and the CVD just keeps coming down. And eventually what happens is we can just keep blowing down through these bids despite there being absorption at a certain place. You need aggressive participation for price to move up. So if there's no aggressive participation from buyers, in this case, price can still continue moving down, and that's why you want to wait for them for the highest probability of you taking a winning trade. So obviously everything I just said for this bullish scenario, this can be flipped in reverse, and it's the same exact logic. So real quick, I'm going to run it through faster than I did before. Let's just say the CVD is moving up off the open, price is moving sideways. Maybe it even takes a high, but there's a clear discrepancy that there's a ton of buying coming in, price is moving sideways. If this is the case, you're definitely going to see some delta on your delta by price. And it's the same logic as before. I am not going to enter this trade until aggressive selling starts coming in, putting all of this buying underwater. And when this happens, you can either enter on aggressive selling or you can even wait for the first pullback to get in short for continuation. The moral of the story is once you identify some absorption, always wait for the aggression from the opposing side. Otherwise, you got a lower likelihood of it winning. I'm not saying it couldn't win. It definitely could end up being a winning trade, but this is just a tip to boost your win rate for this particular setup. All right, so now I'm going to show you guys some real market examples. This one in particular is going to be from GC. From last night's session. This is a trade that I actually took. So just to give you guys some context before this trade, this was a Sunday night. The Sunday opened up, tons of aggressive buying came in, price moved up, and I was basically just looking for a pullback to get long on. So around 15 minutes after the Sunday open, I spot all of this aggressive selling right here, but price is moving sideways. Bottom of the screen, this is the CVD. It is moving down, right? It is trending down. Not that hard to see that, right? So while there was some aggressive selling coming in right here, it started to get even more aggressive right here. So in this little area, specifically right there. So after seeing this selling come in, since it's a little bit more significant, I can say, all right, there's a passive buyer here scooping up all this aggression. And on top of that, you can see this passive bid coming in as well. So price started creeping up above these sellers right here, making them trapped. And I took it long immediately. So this right here is one of those cases where I didn't necessarily wait for significant aggressive buying to come in first. I actually took the trade long as soon as these sellers were put underwater. And my stop loss on this particular trade was right above this little wick right here. For roughly a 2-point risk, I got filled at 40.4 and I was going for roughly a 10-point target up to the 45.50. So after this activity right here, I was in the position. And just to show you guys what it looks like on a 5-minute chart, this is the exact position that I'm explaining to you. And actually during this GC session, that was the first CVD divergence. There was another one right here and another one right here. So there's literally 3 examples of what I'm explaining to you right now on GC last night alone in like the first hour and a half of this particular Sunday session. So now hopping over to ES from today's session. This is going to be a very similar example. What you're going to see is after the open, we get a pretty strong move up, about a 5-6 point rally immediately right here. So I know that was pretty quick, but in the first 30 seconds, we can see some aggressive selling just getting absolutely bought up by passive buyers right here. You could have taken this long as soon as you see the aggressive buying come right back in. Unfortunately, I wasn't able to catch this due to some rhythmic data delay issues I have, but this was a perfect example of a trade worth taking. You get the absorption, CVD divergence, aggressive buying coming in immediately after. You could have taken it long at the 74s or the 75s. Stop loss right at the 72s. That's a 3-point risk. And I would be targeting at least 10 points. And just to show you guys what happens immediately afterwards, we just absolutely rip right off the open. I definitely have it sped up a lot, but right here is another example of a CVD divergence where there's aggressive selling coming into the market. You can see the aggressive selling by the CVD divergence moving down, prices moving up or sideways in this case right here. Sellers are getting absorbed, passive buyers are buying them. If you want to wait for that aggression, you get it immediately after, and this is just another sign of higher prices coming. This area ends up holding aggressive buying coming in. So obviously after that happened, we end up ripping a crazy amount on today's session. Basically, every time there was aggressive selling that came in, passive buyers were scooping it all up, aggressive buying came in, and we get another rally. So it's the same story like every time. Anyways, I hope you guys took some value out of that video. If you need a book map discount, link in the description. Make sure to subscribe, and I'll catch you guys in the next video.